Good afternoon everyone. This is Abid Khan and you are watching Karachians Academy YouTube channel, and we are doing CIE A-level accounting past papers, paper 9706 and paper 3 version 2. So we have selected May-June attempt, and in our last lectures we have done a couple of questions from this paper, and in the last video we have done question 2. It's part A. So we will do rest part of the question B, the question 2, B and C, right? Then let's move on. These papers we have done already. These all A we have done. Now moving on to B. So here in last we have calculated the corrected profit. The corrected profit was 109,650. So this will go to your retained earning, whatever if it is not paid. So, and also there was loss. You remember revaluation loss. This one. You remember? Actually the loss on revaluation was 88,000, and there was a gain in reserve side 72,000 on last revaluation. We have adjusted that. Then net loss is 16,000. That will also be taking to the profit and loss, adjusted profit and loss. So that will be not 16,000. This is relating to the previous years. So this will be adjusted in your retained earning. Profit for the for this year would be the 109,650, but 16,000 will be adjusted in your retained earning because this is a loss. So it means we have to adjust this one and this one both in our retained earning. Move on, and what is required? Okay. In B, explain the accounting treatment of the following with reference to the relevant international accounting standards. Item 3 was what? Item 3 was in financial statement. Yeah, this was the overcharge of depreciation in the previous year, right? 20,000, and this year. So it means this is a prior year adjustment. So prior year adjustment here, accounting standard 8 applies. Policies and changes, and accounting policies and changes and errors. So we will consider that. So, and item number 4 was relating to, okay, this was relating to inventory, right? And here international accounting standard 2 will apply. So we will see the marking scheme just to explain you. In item number 3, accounting standard 8, accounting policies, changes in accounting estimates and errors, because here error has taken place. So we will consider this will be treated under this IAS 8. And what will happen? This 20,000 which was made, the depreciation was overcharged in last year. So this will be adjusted against the retained earning. This is a prior year adjustment. So 20,000 is adjusted against the retained earning at 31st. Whatever the retained earning is there, the retained earning was, I think, 192,000. So this 190. So this prior year. So this we already have 20,000 adjusted against the retained earning, the error of the prior year, and 14,000 is adjusted against this year profit. This 14,000 effect we already have taken, right? 20,000 will be adjusted in your retained earning. So your opening retained earning, this will be a prior year profit because you overstated the expenses. So this will increase your retained earning. We will see how much is the retained earning. This 20,000, remember this 20,000, remember that this will be added into the opening retained earning. And IAS item number 4 relating to the inventory, international accounting standard 2, right? Relating to inventory, this will be applicable here. Inventory is we know the inventory is valued on lower of cost or NRV. So net NRV was 16,400, and our in closing inventory, the value will appear at 16,400, right? Because this is the NRV. So we will apply this standard here. And question number, okay, then so B part we have done, we have finished. In part now, this part we have done. Okay, this is another part C and D. In part C, they are asking state difference between right issue and a bonus issue. What is right issue? Right issue is basically when you issue additional shares to get more finance from general public. So first you give right to your existing shareholders. So when you get money, so it is actually what is the bank, it increases your bank, right, whatever the amount is there, and you ordinary share capital, you credit that whatever the amount is there. So in right issue, what happens, it increases your assets as well as it increases your equity. And bonus share is what? Bonus share, basically we pay the dividend when we when we pay profit distribution, when we distribute the profit, it is called dividend. And dividend you can pay two way. Number one, if you have cash, enough cash, and your cash flow and future cash flow of the current short term, like 3, 4, 5 months is okay, and you can pay, and this will create no liquidity crunch, and you have enough cash, then you pay dividend from cash. So that is called the cash dividend, right? So from bank, right? If you have lesser money and if you pay cash, dividend in cash, profit distribution in cash, that will affect your liquidity position, your cash solvency, your cash position. So you will be in big problem. Then you do not issue pay by cash, you give them the shares. So that is called a bonus. We issue them a bonus shares. And what entry is made? Actually this is a dividend, and dividend is paid from retained earning. So actually your retained earning, you debit whatever the amount is there, and you credit the ordinary share capital. So what happened in bonus shares? In bonus share, if you are issuing a bonus share, so there will be no change in your equity. On one side, retained earning is a part of your equity, it got debited, and ordinary share capital is credited, then the total no impact on the equity. We can see what the marking scheme is saying. So bonus in issue involves the use of reserves. As I have told you, retained earning or from reserves you can issue, either not from the retained earning, you can pay from the reserves. So your reserves you debit, and reserves means revenue reserves, not capital reserves. You cannot pay from the you can pay from revenue reserve and ordinary share capital credit. So involves use of the reserves. It involves use of the reserve, but there is no change in the equity, total equity. Reserves get reduced and capital get increased. So no increase in no change in your equity. Whereas right issue results in company receiving cash. This I have already explained. So move on to question, because we quickly have to finish it, have to keep our videos very short. So, and in C we have done with C. So in D, prepare the statement of changes in equity. The statement of changes in equity, which is the fourth statement in the financial statements, the four financial statements. So this is the fourth one. You have to make the changes in equity ending 31st December. So we will see how it will work. Let's move on and see. So this is opening equity, right? This is opening equity, opening shares, share premium, revaluation reserve, retained earning. Here in retained earning, you should add this, that 20,000. Remember 20,000 of what? Of understatement of last year profit by depreciation. So this will be your 192. Let me open up my calculator. So 192 plus 20, your retained earning will be 202,000. Fine. So it means our balance will be, this will get changed, 212,000, right? Sorry. Okay. Now see what other things are there. One is retained earning, and in opening retained earning, fine. During the year 31st December, during the year ended 31st December 2021, the following transactions took place. There are a few transactions. On 1st February, the final dividend of 0.08 per share was paid from 2020 profit. So this is the final year profit. Last year dividend, you normally dividend is not paid in the same year, it is paid except of the interim dividend. But final dividend is paid next year. Next year when it is paid from the last year's profit, right? So how much? This is rupee 1 share. So number of shares would be same dollar amount, and shares would also be for 500,000. So how many on February 1st the final dividend of 0.08 per share was paid from this. So this I can say this is working number 1. So your dividend you will pay dividend paid, and this will be on 500,000 shares at $0.08 dollar, right? How much is this? This will be 500,000 into 0.08. This is 40,000. So 40,000 is the dividend you are paying from your. So we have to make statement of changes. So I can make this here right away because all the data is here. So I can prepare a statement of financial changes, which is D, statement of changes in equity as on 31st of December 2021, and this is your 355. So we have to finish this very quickly. D, and what I will say, we have to means how much is our ordinary share capital, then share premium, then revaluation reserve, then retained earning, and then total. On 1st of January 2021, so your opening balance 500,000, share premium you have balance 86,000, and then just 1 minute, 500,000 and then 86,000, and revaluation reserves you have balance 72,000, retained earning you have this much balance, or I can say we can write it here 20,000, so this will be 212,000. This I already have explained you why I'm doing it, because I must have the space here to finish my question. So 72,000 and the retained earning is 212,000. So how much this will be? Our opening will be 5, get short, 500,000, then 86,000, and then 72,000, and then 212,000. This is $870,000 of your equity. This is opening, right? Then we move on and we put all the entries accordingly. So what he is saying, the dividend paid. So when we pay the dividend, you know what the entry is made is basically, you are not supposed to make the entries, but I am just making just because to make your concepts clear. So then this is paid from the last year profit. So retained earning debit, and how much? 40,000, right? And your bank is, because you are paying, this is a cash dividend, and you are paying by from your bank. So we can say dividend paid, final dividend, or we can say final dividend paid, how much we have paid. So, and we are debiting retained earning, means retained earning, we are reducing the retained earning. Where is retained earning? Retained earning is here. So this 40,000 will get credited. So 40,000 in total will get reduced due to payment of dividend. So then move on. We have very short time. In short time we have to, because we have to keep our videos very short. On 5th March, remember the dates and very carefully, a bonus issue of 1 ordinary share for every 10. Okay, then I can say this is my working number 2. My number of shares are 500,000. So for you are issuing 1 share for 10, so divide this by 10, means you are issuing 50,000 bonus share, a bonus issue of 1 ordinary. On 5th March, you are issuing a bonus. Bonus means you are paying dividend, stock dividend you are paying dividend in the form of shares, right? The above 140,000 was your cash dividend, and this is your stock dividend. We sometimes call it stock dividend, and normally it is called bonus shares. So 50,000 bonus shares you are issuing, held, was made in the policy of the company to keep its reserves. This is very important point. It is the policy of the company to keep reserves in most flexible form. It means the business has to keep the flexible reserves ready, and all the time they should have in hand. So some kind of adjustments or payments or dividends or whatever, they should not make from the means from revenue reserves. Just understand one thing, there are capital reserves and revenue reserves. Revenue reserves include retained earning, plus this include general reserves, right? Means revenue reserves which have been created from the profit, the operational profit, right? So this is the most flexible one, right? This can be used everywhere, but the capital reserves have certain limitations, so they are less flexible. So what the company is, what the requirement is here, so you company has to keep the reserves in most flexible form, means whatever the payments or rest of the things are there, if they can do from the inflexible reserves, they settle all of the payments and all the things from inflexible reserves, means capital reserves, right? They should use lesser amount of the revenue reserve, and it should remain free. For any emergency, you should be able to use your flexible your revenue reserves. So this is called keeping the reserves in a more flexible form. Fine, hope this is clear. So what we will do, so bonus 50,000 of the bonus, on March 5th the bonus issue of 10 every share was held, was on 5th. Okay, it is policy of the company. So we will make this from just 1 minute, let me see the question. Just 1 minute. Okay, so what we will do, the bonus shares we will pay from, because what things we have, this is revenue reserves, this one is revenue reserves, this is capital reserve, this is capital reserve. So revaluation reserves you cannot distribute. This is very clear, guidelines. So in capital reserves you have share premium, and this is the capital one, and revenue reserves you have retained earning. So you have to save your revenue reserves, keep your reserve in a flexible form. So this will be paid from, or this will be adjusted from the share premium. So what entry will you be making? So if you are then you if you are issuing a bonus share, then ordinary share capital will be credited with 50,000, and 50,000 share premium will be debited. So you will pay from your share premium. So in equity sides we can see what entry we will make. So bonus shares, how bonus shares are affecting, share premium is reducing, so we will reduce share premium by 50,000, and share capital is increasing. So okay, I will write it here just to save my space. Short time, we are running short of time. It's 50,000. Fine. Oh, okay, my apology. 5,000 and then minus, sorry, 50,000, then minus 50,000. There will be no impact on total, right? There will be no impact on total. Okay, then come, what is the other one? We have done with this. On 1st June, 100,000 new ordinary share were offered to the public at 1.8. So we can say this is our working number 3. So 100,000 ordinary shares were offered to the public at 1.8. AB Public Limited received subscription for 80,000 shares. So they have actually received 80,000. They issued 100,000 but received 80,000. It means on 80,000, it means this one is your normal capital and this is your share premium. So how it will work? 80,000 you will be getting money, and what its entry will be, if I want to make its entry, then ordinary share capital with 80,000 will be credited, and 80,000 shares multiplied by zero point 0.8 premium, 64,000 you will get the premium, share premium, and 64 plus 80, this will be 80 plus 64, this will be 144,000. 144,000 you will be getting money you are issuing, right? So if we update this, this is a new issue. So 80,000 increasing 80,000, your capital, new issue, and your premium is increasing by 64,000, right? So then 144, your total, there is impact of 144 in your equity. So actually we are running short of time and we have to finish it quickly. Now we have done with this. Now on 1st September, an interim dividend of 0.02 per share was paid on all shares held. This is important point. Shares held at 31st of March. How many shares they hold at 31st of March? This we can say this is our working number 4. So we had 500,000 shares opening, and then we issued on 5th of March. Here on 5th of March we issued 50,000 more shares, right? So 500,000 plus 50,000 more shares, right? Just 1 minute. 50,000. So you got 550,000. 550,000 are your share, and you are interim dividend you are paying 0.02. How much it will be? 550,000 into 0.02. This is 11,000. So this is your interim dividend paid. So what its entry will be, if you want to make its entry, so you are paying this cash you are paying, so means bank will get credited by 11,000, and you will pay it from your retained earning 11,000. So you have to reduce your retained earning. So here your retained earning is reducing by interim dividend. This retained earning will get reduced by 11,000 from interim. I am deleting all of these, right? Okay, we are running short of time. Interim dividend. Dividend paid. How much? It was 11,000. So 11,000. Your total equity will get reduced, right? 40,000. 40,000, 70. Okay, fine. Now, what else is there? We have done with this 4. 5th, on 31st December, a final dividend of 0.09 per share was proposed. Okay, this is final dividend which was proposed on. So this has nothing to do. This has no financial impact. Proposed dividend is simply a proposal. So this appears as a footnote on your balance sheet, or simply it is not paid, because this is a proposed, it has no impact, so we will not be considering this, right? So almost we have done with all, but we have to consider this, because our in my last I told you that how much was the profit and revaluation loss. This you also have to consider. 109 and 650. 109 650. This is your profit for the year, 109 650, and revaluation loss, how much it was? It was 16,000. So revaluation loss, this will reduce, this will be charged to your retained earning as a loss. So 109 650 will be your profit, 16,000 is a negative. So now we have finished with this 500,000 and 50, 500 plus 50 and plus 80. This is 630. How much is your share premium? 86 minus 50 plus 64. 100,000 is your share premium, right? 630, 100,000, and this revaluation reserves. Yes, here what we have to do, you know, you remember this was the opening balance, but this got adjusted against 88,000. You remember what was the actually you loss on revaluation was 88,000, and you have already had 72,000 reserves. So that reserves will be adjusted against it, and then we took, this was the loss, net loss. So this net loss we have taken here, and this 72,000 was finished. This was adjusted, right? So there will be no balance. So revaluation loss, reserves for revaluation. So we can show this here, minus 72,000, right? No balance. So what will be this? How this will be? 212 minus 40 minus 11 and plus 109.65 and then minus 16. This is 254,650. So we can do 630,000 plus 100,000 plus 254,650. 984. So your equity would be 984 and 650. So this was your opening equity, and this will be your closing equity, right? So guys, thank you very much, and we have done with the part D of this question. We are running short of time, so we have done question number 2 completely. So for any clarification or doubt, you can write your comments on this video, so we will try to reply you or get back to you very quickly. So I believe this video will help you in next week exams, and that's all for today. Thank you very much, and bye for now.